Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey, Paul. Welcome back, buddy. How you doing?
Great, man. Just got back from Rhode Island. Phenomenal visit, picking up the kids. And
Doing what were you doing there?
so we sent the kids up there to spend time with Tammy's parents, and they live on a mooring out on their boat in the summertime. And of course, when I say that, everyone's like, "Oh, he's married to a sugar mama. She comes from a ton of money." And well, listen, they've owned the same boat since 1996, and it's a nice boat. They've kept it in really great shape.
Yeah.
But anyway, yeah, they waited like 25 years to get this mooring because it's on a lot like a waiting list essentially, kind of like Fenway Red Sox season tickets. You know, someone has to die to get one.
Oh, yeah. Gotcha.
So yeah, we went up there and picked them up, spent a few days with some friends up in Rhode Island, and just had a ball.
Yeah, nice, man. Yeah, I spent the weekend on base, drill weekend, got promoted.
Hey,
And,
look at that,
yeah,
Lieutenant
yeah.
Colonel Befford, everybody.
Yeah, look at that. Yeah. So now I don't have to call you sir anymore. So
That's right.
not that I ever did.
No, you
Yeah.
are older, so I should be calling you sir.
It's true. I am your senior.
5 months older than I am. Or
Yeah.
something.
Yeah. Well, let's get into it, man. We this might be a heated topic for some out there, but it's actually a real topic of confusion. So I wanted to start with a question that recently came up on that IBC video that I have out there on YouTube. Mr. DC left a question here, and I really appreciated his question because he seems genuinely interested in understanding. But I will, I'll read this. Kind of a long question, but here it goes. DC says, I am curious to understand why IUL, he's talking about Index Universal Life, isn't embraced with this concept, the infinite banking concept. A friend set up an IUL for me 7 years ago. I've been able to max fund my policy, and in the last 7 years have averaged 15.4% rate of return with an S&P uncapped strategy. Earlier this year, I've decided to put my cash value in the basic interest account since the market was indicating downside and now earn 3% for the year. Another feature is the index loan I was able to take out in 2019. So just like whole life, you can take cash value loans against ULs. I was charged 5% for the loan, but my index performance was above 20%. Therefore, my loan arbitrage was positive. Is this also available for whole life? I understand whole life has the guarantees, but how is IUL not recommended for this? It sounds like he just answered his own question.
And he says this IBC.
Yeah, why is IUL not recommended for IBC? A sincere answer will be truly appreciated as I'm trying to learn more. Thank you. Thanks for the question, DC, and I hope this episode fully answers your question and more. So, all right, well, why don't we're not going to dissect this right away. We will we'll answer this throughout this episode because this episode is going to be all about universal life insurance and why it's not the right fit for the infinite banking concept. So, Paul, how would you start off with responding to DC?
Yes, it's a wonderful question, and I've actually I've had at least one client that we basically did an IUL rescue. Luckily, it was fairly early on, but here it is fundamentally for me. Would you rather have a product that gets more efficient with time and less costly, or a product that gets less efficient over time and more expensive and more costly? Well, the answer is clear, right, Dave? What would you want?
Yeah, I want the product that gets more efficient over time and is less expensive, costs me less money as
Right.
time goes on. That makes sense to me.
Right.
Yeah.
And that for me is the fundamental answer of why universal life is not an appropriate permanent life insurance product.
Right. And certainly not an appropriate product for the infinite banking concept.
Correct.
So, yeah, so either if you want permanent life insurance or if you want to utilize it for IBC, it's not the appropriate product. There may be a place for it, and we'll talk about who universal life might be a good fit for later on in the show. But I feel like it really starts with what was Nelson. Let's go back to Nelson Nash.
Yep.
Nelson Nash discovered the infinite banking concept. He coined the term infinite banking concept, IBC for short. He started the Nelson Nash Institute to make sure that this concept was being taught appropriately and was used responsibly. So, what does Nelson say in his 92-page book, Becoming Your Own Banker? Well, one of the things he repeats throughout the book, in all of his books, is it's all about the way you think. So really it comes down to why. Like one of the things that you probably do with your clients, Paul, just like I do, is I tell them, hey, the first step is understanding, being educated and understanding why do you want to use this concept in the first place. Right. So it comes back to the why. And if you want to do it to learn how to finance the things of life and use that as your banking system for financing the things of life, then let's do that. But we're going to do that with whole life insurance, and we'll talk about why. So it's all about the way you think. So what else does Nelson have to say about this, Paul? I think we were talking about this before the show, and we opened up to page 3. So
Yeah. Let me just read directly from the book, and this is not specifically about universal life, but it gets to the point of, insurance and investing. They're two different things, and they ought not be combined. And let me read this. This book, this is Becoming Your Own Banker, written in 2000. This book is not about investments of any kind. It is about how one finances the things of life, which certainly can include investments. It's not about rates of return. As time goes by, interest rates are up and interest rates are down, but the process of banking goes on no matter what is happening. It is a well-known fact that banks make more money during times of low interest rates than when rates are high.
So you said something that's underlined in both of our books. Mm-hmm. It is not about rates of return.
That's right.
Yeah. So I feel like anytime we get into a discussion with somebody who's very pro IUL, it's always focused on rates of return. Like, look, you can get much greater rates of return inside the IUL product than you can in whole life. And I feel like that's really the only thing they go back to.
I would ask the agent, does an IUL product or any universal life product have some kind of magic sauce that a regular old index fund or, Goldman Sachs indice has, or that those don't? It can't.
Right.
It doesn't.
Yeah, there's nothing
Right.
magical about it, right? And there's no deals in life insurance, as they say,
Right.
as we repeat.
There's only risk management.
Right. So let's talk about risk.
Yeah.
What do we like about whole life insurance?
Okay. So my clients have heard this when we have these discussions, right? The purpose of any type of insurance is to transfer risk from yourself to the insurance company. Let me say that again. From yourself to the insurance company, right? Universal life does not accomplish that. The consumer, the policy owner, the insured, if he's the policy owner, is assuming all of the risk. And you can talk to any life insurance company. They're going to tell you that. What guarantees does this product have? Minimal, if any, right? So again, transfer of risk, it defeats universal life, fundamentally goes against the whole purpose of insurance, in this case, life insurance.
Right. So there's investing and there's insurance. What Universal Life aimed to do in the 80s when it was created by some
It was E.F. Hutton.
E.F. Hutton, who is no longer even around.
Yeah.
Right. It was created to combine those two things to make it sexy and appealing to the mass market because interest rates were so high at that time.
That's right. You could get 12% or something in a CD, and of course, wow, this is great. And sure, they illustrated really well back then, didn't they?
Yeah. Yep. Exactly. And they illustrate really well today.
Sure.
Right. But what is an illustration?
It's just a piece of paper with numbers on it.
It's a piece of paper with numbers on it that oftentimes is the only thing used to sell this to the audience.
Yeah, I'm
right,
sure they can't get those in front of the guy quick enough, right?
Right, and that's a red flag. If you're working with an agent and the very first thing they want to do is create an illustration for you and walk you through an illustration, that to me is a red flag. Because that illustration is just what it says. It's an illustration. It's not a guarantee.
Yep, it's not a contract.
It's not a contract. It states that on the illustration itself. This is not a contract, and there's no guarantees on that. So,
Right.
so going back to the whole rate of return argument, it's not about rate of return. It's not about the return on your money. It's about the return of your money. So let's replace on with of. Like with my whole life policy, I'm guaranteed to have access to a certain amount of capital as long as I live, and I'm guaranteed that my premium's never going to increase.
What's that worth?
Yeah, what's that worth later on in life? So as long as I continue paying my level and really decreasing premium, because at some point your premium has to decrease.
Yep, it's hugging that mech line, right, as the years tick by.
Right, and the calculations are done. It says, hey, you've paid enough, paid up additions in this. We have to knock you down, and you can only fund this much now. Okay, so I have a decreasing premium. At worst case, it stays the same. Actually, best case, it would stay the same, because ideally, I want to pay as much premium for as long as I possibly can.
Right, that's a different discussion.
Yeah.
But yes, you are
Yeah.
100% correct.
So return of my money is going to be there. And I'm not so concerned about the rate of return inside my policy. I know I know that the cash value is going to increase every day. I know that death benefit is going to be there when I die. I know I have access to that cash value. It doesn't cost me anything, no fees, nothing like that, to go in and access that cash value through a policy loan. But what I use that for is getting multiple rates of return outside the policy.
Yep, that's right. And again, you just go back to Nelson Nash. He literally says it is not about rates of return, right? Our focus ought to be, just as you said, what are we doing outside our policy with our guaranteed access to the capital that we've accumulated, right? So I'm hoping we're getting to his answer, but there's more.
Oh, there's plenty more, and we probably won't have enough time to get to everything. Luckily, there's plenty of other resources out there we could point you to. But
Yeah.
So let's go back to the risk. What's the real risk of IUL, of universal life? Because I preface that with saying everybody's going to say there are guarantees. You're guaranteed to be able to, you can partake in the gains of the market, but you're guaranteed never to be below zero.
Right.
Right.
Well, I think I'm gonna combine a couple of our bullet points here. The real risk, right, is as one ages, the cost of insurance goes up. So this is where I'm going to unpack the structure of what universal life is, the chassis, if you will. The frame of universal life is annually renewing term insurance. Well, Paul, what is annually renewing term insurance? Well, unlike a level term, where the premiums are fixed for that term of 10 or 20 or 30 years, universal life, and again, contracts vary, right? So I'm talking very generically here. There might be a guaranteed level premium on a universal life contract for a 10-year period. Maybe it's 15, maybe it's 20 years, right? But after a certain point, right, as we get closer to death every year we age, the cost of that insurance, that annually renewing term, is going to get more expensive. And we can show people this very simply by just illustrating a term insurance policy on a 60-year-old person versus a term insurance policy on a 30-year-old person. The cost of insurance is exponentially higher in that 60-year-old person, right? So every dollar in premium does not produce the same amount of death benefit as it would for someone half their age, which makes perfect sense, right? So that is the biggest risk, is that people don't also know what they're buying, and they're paying premiums. I'm max funding my premium, as DC said, and I think I'm doing what I'm supposed to do, and then all of a sudden, I get a letter in the mail saying, "Hey, your policy's about to lapse," and it takes people by surprise, because let's face it, most people take their life insurance contract, they stick it in the junk drawer, and they don't even know what they have. Well, I think I have whole life, or I think I have universal. They have no idea.
Well, how many times have you talked to somebody who You ask them, do you have any life insurance right now? Yeah, I do. I've been paying, however much a month for the last 8 years. Okay. What kind of policy is that? I think whole life. Okay, tell me a little bit. No, that's universal life.
Right.
So they don't understand. And just like you said, I think there are some very, I'm sure there's some very good, there's some very educated agents out there who sell universal life predominantly. And, I'm sure they, they're very educated. They know what they're doing. They know what they're talking about. Here's my concern is that their clients don't know enough about that policy to really make a smart decision. I've never talked to anybody who I say, hey, give me a copy of your in-force illustration and let me take a look at that. And then let's walk through it. Like most of them can't tell you what kind of life insurance they have in the first place. But then once they look at it, they can't tell you anything except, hey, I'll never be below zero. And if the market's up, I get to partake in that.
Right. That's how it's sold. Like, hey, it's all upside, no downside, no discussion of risk, no discussion of guarantees, no discussion of what the policy looks like when I'm 75 or 80.
Right.
And I can't afford the term insurance anymore because, the premium is now $50,000 for that $1 million term for the year. And
yeah,
yeah.
And it's eating up all my cash value. So I can't really access that cash value because I needed to pay the premium next year. And hey, the longer I live, the worse this gets.
Yeah, I don't know if it was on your LinkedIn page the other day where we were having some discussion with a guy about universal life, and I don't remember where we were, but James is on there, a few other people, and my question to the guy was, "Hey, when can I stop paying premium on this universal life policy?"
Yeah, and then crickets.
And
I think, right?
total crickets.
Yeah,
he didn't respond.
Yeah. So break that down. So you say
Yeah.
you can't ever stop paying premium on that universal life. Can you stop paying premium on your whole life?
Sure.
Okay.
Yeah, so
How?
we've talked about this before, but this is good. This is good to discuss. So whole life insurance, any type, dividend paying, non-dividend paying, stock, mutual, doesn't matter, has something called reduced paid up insurance, where I can be, let's say I'm 30 years into the policy, 20 years into the policy, doesn't matter. And I say, a client calls you and says, hey, Dave, I don't want to, something's happened. I can't really afford the premium outlay. What are my options? One of their non-forfeiture options where they get to keep the policy, it stays in force, no more premium is required to keep the policy active, is reduced paid up, or sometimes referred to as RPU, right, in the industry. Yep. And guess what? That does not exist in universal life, any type.
Okay.
There is no non-forfeiture option. You are paying increasing premiums as the years tick by once you get outside of that level premium period, if it does exist on your policy.
So with whole life, you can continue to pay your premium. Say you don't want to pay it out of pocket. There's a few different options. Like you said, you could RPU, but if you want to keep it going, you could just direct the dividend to go to pay the premium. You could take cash value loans to pay the premium.
Yep.
Now, what are the ways to keep the universal life policy going?
Sure. Well, one thing is you could reduce, and this is where the flexibility, that's another sales point. This is so flexible and so easy. Whole life is so complicated. I think it's the complete opposite.
Yeah, no, I would agree with you.
I think whole life insurance is like literally the simplest financial product out there.
It's very simple. Yeah,
super simple.
Yeah, once somebody, read a book, you'll figure it out, or have a conversation with us and we can explain it to you very simply. Yep.
Yeah. So universal life, any type, I don't care what type you have, you can reduce the death benefit, right? That's one way to keep the policy in force. I'll reduce the death benefit, right? You can increase your premium to pay for that ever rising cost of insurance.
Out of pocket, right?
Out of pocket.
Yep.
And then you have your cash account, right? And you could use cash values from that. It's not a cash value though, it's a cash account, right? It's a very important distinction. With universal life, they have unbundled the savings component of whole life, and then your side account is either whatever, mutual funds or some kind of indice that it's tracking, or it's whatever, right? That's the other way you could pay. So reduce the death benefit, increase premium, or diminish the side account, or hope that the market does 22% every year for the next 30 years, every year without interruption.
So then I'm curious, why would I get universal life as opposed to simply just investing in in an index fund myself?
I don't know.
I don't. I
I
don't know either.
I I have told that particular client, I was like, listen, I don't care if you buy a policy from me, but we can rescue this. Or what I recommend you do is this: if you want coverage, buy yourself a 30-year term policy, super cheap from a stock company out there on the market, and invest the difference. And I hate saying that because it
Whoa,
goes against everything
Paul,
I
that's
believe in.
blasphemy.
It's
Can't believe
blasphemy
you
for an
just said that.
IBC guy.
Yeah.
But I think it would be a better option than buying this universal life where you're just going to likely pay premium for a long time. You think you got this permanent insurance because that's how it's characterized somehow. And then, permanent insurance with a lot of risk to the client.
Yeah.
And then, the policy lapses, or it's not what you thought you had. Hey, I thought I was going to leave $1 million when I was 99. Well, you're probably not. I'm not saying it's not possible, but
Right.
that premium outlay is going to be massive.
Yeah, it's not impossible, but it's not guaranteed.
Right.
Right.
Well, why would you want guarantees in life?
Why would you want guarantees if they're handed to you on a silver platter?
Right.
So let's get into who you just alluded to who universal life might be for, like somebody who is not concerned with leaving a legacy. Like that's not a big priority. They don't need the guaranteed death benefit when they die to leave to their heirs or a trust or a grandchild, whatever.
Yeah.
They're not that concerned with it. What would be another characteristic of somebody who maybe, if this is you, look into universal life?
Yeah. Another type of, high risk. We always hear this anyways, like high risk, high reward, high rate of return potential. That's another person.
Yeah. So let's go back to, and that makes a good point. You got to take high risk to get high reward, right? That's one of those common myths, as far as I'm concerned. But when it comes to this, I think that's accurate. You're taking a higher risk to potentially get a higher rate of return on your cash fund. But going back to the fact that there's no deals in life insurance,
Nope.
there's no deals in insurance, period.
Love that.
So because you have the potential of getting a higher rate of return, you are therefore taking on more of the risk for the performance of that policy.
Yeah, no question. And I'll speak to DC here. And I think he should ask his friend as well. I mean, that would be a good discussion to have. But you are assuming, as the consumer, as the owner of a universal life product, you are assuming all the risk, not the company, right? Not the life insurance company that's issuing that policy to you. You, the consumer, the owner, is assuming all the risk.
Yeah.
100%.
Yeah. I mean, there's a risk that you die and they pay out more than
Of
what you
course.
put in, right? So
no question.
that's risk on the insurance company's part, but they mitigate that risk by the rising cost of the annual renewable term insurance.
Right.
As you
It's
get
all
older.
baked in. Again, they're not they're not in the business of losing money in the insurance industry. The insurance industry is a very stable, very profitable business. Where again, we've alluded to Warren Buffett buying Geico a number of years
Yeah.
ago. So there's a reason for this.
Yeah, well, unless the insurance industry or the insurance company gets involved in a bunch of wonky marketing things, and then they all of a sudden they go out of business.
Yeah, or they do business with what's his face, the Ponzi scheme guy.
Yeah, with Bernie Madoff.
Yeah, Bernie Madoff.
Another person this might be for is somebody who wants to combine investing and insurance. So if that's what you want to do, go for it. I just don't see why you would ever combine investing and insurance. Why would you do those together when you can do them separately? And with the insurance, transfer all that risk, offset all that risk to the company, and only take risk with your investing.
I think we need some guarantees in life. We have a family friend that thinks that's what we're doing because they made the comment to us, well, we don't like to combine our insurance or our investing. I'm like, we didn't get into it. But I was like, well, that's not what we're doing, but
Yeah.
thank you.
Yeah.
They are right. They're right, though.
Yeah, good for them. They
Yeah.
Yeah, you should give them a book. A 92-page
tried.
book.
I've tried. It's been years by now, and
Yeah.
if you don't get it by now, folks, you're not going to.
Yeah. Well, and then going back to what you just said a couple minutes ago, Paul, if this is you, if that describes who you are and you're always chasing that high rate of return, you're willing to take higher risk, you want to combine insurance and investing because it sounds sexy or for whatever reason, we would recommend, instead of getting an IUL or UL, go buy a 20 or 30-year term policy and invest the difference.
Yep.
That term
That's what I
policy
would
is guaranteed
recommend.
to be level and a lot of times you may be able to keep that term policy beyond the expiration and just start paying a annual renewable term
Yeah,
on
you
that, which
could.
will be significantly higher, but you could
Very
still keep
expensive.
that insurance in place and just say, hey, give me one more year of insurance.
Right. I'll do them one better. Because some people have like these awakenings, right? You get smarter as you get older, supposedly. So someone might wake up during that 20 or 30-year term and realize, oh my goodness, I've been doing the wrong thing. In that case, we recommend you buy convertible term insurance that's convertible into whole life
Yeah,
during the term that's in force.
absolutely. Even if you hate the idea of
Whole
whole
life.
life, and
Right.
if you do, you're probably not listening to this podcast anyway. Uh, but if you hate the idea of whole life insurance, it doesn't matter. Get convertible term insurance because maybe you're, 19 years into a 20-year term policy and you get cancer
Yep.
and, the doctor
You still
says,
have a
hey,
need for insurance?
yeah, you probably still have a need for insurance and you'd like to keep that insurance in place. You'll be able to convert it without underwriting. Doesn't matter. You're
Yep.
guaranteed to be able to convert it and keep that insurance going for your family's sake.
What's that
So,
worth?
yeah. So that's who we think, universal life would be good for is people with those attributes. If you can't, and I think maybe that's where I'll go with this. When I've worked with people in the past who they just can't get beyond that rate of return. Like, well, man, the rate of return, I could do better in the market or I could do better in a universal life. Well, then I can't help you. But if you want to go that route, go get a term policy and put the rest of your money into the market.
Right.
Yeah. So,
Well, that return that they're going to make, Dave, that return is going to come back to them, hopefully. Hopefully they do have a nice return. Where does that money go? Into somebody else's bank.
right. So you
In
still
our
haven't,
case, you
go
still haven't
ahead.
addressed your need for finance or who controls the banking function in your life regardless. And that's what we're getting at with IBC, right? That's
Yeah.
the essence of this.
Yeah. You still haven't, you're not participating in the function of banking, which the process of banking continues whether you're involved or not. That's what Nelson
That's right.
says.
Yeah.
So why not get involved? And the best way to get involved in that and have the guarantees that come with banking, because banking involves guarantees, is through a properly designed dividend paying whole life insurance policy for the function of the infinite banking concept.
That's right.
Yeah. So yeah, it's before we wrap this up, I think we covered all of DC's question, but
think so, too.
he asked, yeah, can you take part in the arbitrage for in whole life? Of course.
Of course.
DC any cash value life insurance, you can borrow against that cash value, and yeah, you can partake in the arbitrage as long as you can earn on your own a higher return on those funds outside than you're paying to the insurance company to borrow that, of course. So if you're paying 5%, you can go earn 10%. Yeah, you can do that with any cash value insurance policy.
Yep.
Yeah.
No, that's
Uh,
right. And
yeah.
I would point DC back to Nelson. I don't know if we're going to wrap it up here, what we're up for time, but I would say this. If you haven't read Nelson Nash, and I'll say this in general about any agent out there, if you're working with an agent and they say, yeah, I know IBC, you need to find out. You can look them up on the practitioner finder through the NNI, infinitebanking.org. Or if they're trying to sell you universal life, you automatically know that they are not doing IBC. If someone's selling you universal life, they're not doing infinite banking.
They're not. They're not. Just
They're not.
plain and simple, because in the book, Nelson says in black and white, I do not recommend the use of universal life for this concept.
That's right. So in chapter 9 of his second book, Building Your Warehouse of Wealth, which is this podcast is named after, if you didn't get that, I'm holding it up, but Building Your Warehouse of Wealth, chapter 9, my thoughts on universal life, variable life, and equity indexed universal life, also known now as indexed universal life, IUL.
Yeah.
Now, Nash talked about it, and he says, bottom line up front, not appropriate for IBC, and here's why.
Yeah. Now, what about to the people who maybe have an IUL or universal life policy that maybe they've had it for, like I just talked to somebody last week who has had a policy for the last 8 years, and it's still not to the point where her cash value is growing by more than what her premium is every year.
Ooh,
Yeah. So
that's awful.
Yeah, that's pretty bad.
That's pretty bad.
But here's the good news. If you have a universal life policy and you have all that cash value and everything, and unfortunately there's surrender charges, sometimes significant surrender charges if you give that policy up and you want to take your cash value out.
Imagine that.
Yeah, it's
I don't see those with whole life.
no, you don't. No, you just get your cash value.
And that's, yep, your cash surrender value.
Yeah, cash, which is always higher than really what your available cash value is, right, by a little bit at least. But you can, as long as it's not a mech, you could actually 1035 that policy into a whole life policy, which I've done for a couple clients.
Sure.
And I don't do that lightly.
Right.
But in the case of these clients, their policy was about to implode. It looked like, it wasn't doing any good for them. It wasn't designed properly.
How
in
old
the
were
first
they?
place. The first client I did that for was 62. The other client I did it for was like 60. So I think they'd been in those policies for a number of years, and they were getting to the point where they were looking at them and saying, that's not doing what I thought it was going to do. So we rescued them. We moved their cash value over into a whole life policy, and they had to start from year one. So it's going to take a few years to become efficient, but it doesn't take very long for it to become more efficient than a lot of those policies that maybe were designed, not to accumulate that cash value quickly.
They added, Nelson was an aviator like we are, and he always talked about headwinds and tailwinds. Universal life at that age is like 100-mile-an-hour headwind in your face.
Oh man, yeah, you're right. It causes so much drag.
You're flying 100 knots and you got a 100-knot headwind. That means your ground speed is 0.
Where
you're not moving.
The complete
Or
opposite.
actually, maybe you're moving. Maybe it's 105 mile an hour in your face. You're moving backwards now.
You're backwards
those guys are
5
moving
miles an
backwards.
hour. Yeah, and a lot of people are later on there. With the whole life policy, you're guaranteed to become more efficient every year. So once you're 30 years into it, you've got a
Oh my God.
you've got a 150 mile an hour tailwind. So you're
That's right.
at a 150 mile an hour indicated. That's 300 miles an hour ground speed, right?
I stole this from James. A whole life policy is the most efficient on the day you graduate. For those of you who don't know what graduate means, the day you die.
The day you die. Yeah.
The day you die.
You're
Your
right.
whole life policy will be the most efficient on that day.
That to me, that's comforting, because I know the longer I stay in this. So I think, again, back to people who might be right for universal life is people who don't have a long look, a long-term point of view on their planning and their use of money. It's very short-term, arbitrage. They just,
and I'll speak to DC directly again. You just got to get out of the paradigm, the investment paradigm. Infinite banking, dividend paying whole life is not a this or that process or strategy. And the whole life product is not a this or that product. It's an and. I do this and I do that and I do that and I do that.
Yeah.
It's just a place to park our capital, right? It's so we can become our own banker. So once you can understand that it's more about banking and finance than it is, that the whole life product has more characteristics of banking. Of course, the life insurance companies don't teach this. It took a private citizen to discover this, right? But once you can get past that investment paradigm, I'll say it again, is just that's when it'll kind of click for you, where it is not an appropriate product. But again, illustrates well, looks great. I don't know how old you are. Looks great when you're 30, 40, 50 maybe, but past that age, as we've seen, it's not good.
Yep. So to wrap it up, like Paul said, it's all about the way you think. So that's how we started. That's how we'll end. It's all about the way you think. So pick up the book, give it a read, as we always say. And and we look forward to talking to you. If you guys got any questions, look us up, send us an email. We're happy to chat.
Bring the hate mail, UL guys.
Bring it. Yeah, here it goes. Here it comes.
No, it's all in good fun, but
yeah, we're not saying anything bad about the agents. We're just saying something bad about the use of the product for this concept. That's it. So there you go. All right, guys. Hey, we'll see you all next week.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.